There is a frequent news about large funding rounds of startups or well-known angels like Kunal Shah investing in growing startups. For example, Reliance Retail recently led a $240 million funding round in quick commerce firm Dunzo. An unlisted company is the company whose shares are not available to the general public for trading and are not listed on a stock exchange. Now the question is, why do people want to invest in an unlisted company? And there are multiple reasons for that. Investing in futuristic disruptive industries can result in significant value creation. By the time the company decides to go public, your money could have easily doubled or tripled. Apart from the potential for high returns, these investments help in diversifying your portfolio with the sectors that aren't even listed on stock market. According to Startup India, India is the third largest startup ecosystem in the world, expected to witness year-on-year growth of a consistent annual growth of 12 to 15%. This sounds good, but how do you invest and participate in the growth of these unlisted companies? And is it necessary to have a strong connections and be a millionaire or billionaire in order to invest in these companies? And the answer is no. You can easily invest in a startup with minimum investment of 2 lakh through GRIP. GRIP provides curated deals to individual investors under which they can invest alongside venture capital funds and strategic investors in startups. While investing in startups can be very beneficial, it also carries a high level of risk. An investor can lose the entire investment, as many early age businesses are at the risk of failing or barely surviving with no profits or growth. Another risk is the investment's illiquidity. Even if the startup becomes successful, it could take years before you see any of your money again. Exiting from investments require an initial public offering, IPO, a sale on exchange, or a later sale in the secondary market. Now, what can you do to minimize the risk? You should try to learn as much as you can about the business in which you are investing. Do your research to understand the startup and select the ones that appears to be promising. It's never a good idea to put all your eggs in one basket. So it's better to go for a diversified portfolio. Consider how much risk you are willing to take and whether you are willing to lose all your invested funds if the startup fails. Hope you found this video helpful. If yes, then hit that like button and subscribe to our channel to get a grip on your money.